Okay. So speaking to that point here, stock and bond annualized returns. You can see that, John?
Yep.
Okay, perfect. So the calendar year is on the bottom. And then the blue lines, the bars are S&P 500, and the gold bars are the aggregate bond index. Okay. Up means guess what? It's up. Down means it's down. The average since 1990, the U.S. bond aggregate bond has been a 5% return. The S&P 500 return has been 11. Okay. But to your point, John, guess what? Bonds were down, in double digits last year, and currently they're down this year, which is extremely rare. So
As you can see, the rest of the chart, it hasn't happened since the 90s. The normal thing you see with bonds is where you see they give you that 0 to 10% return steady eddy, and that's been problematic. We haven't had the interest rate cycle that we've had, the last 3 years. The Fed hasn't had to fight inflation as bad. Remember there was that word transitory at the beginning of this debacle, but they have a better control of it now. I guess the good news I would say is I think we're nearing the end of the interest rate hike cycle, which should be favorable for bonds going forward.
yeah, and that's going to go back to this, where if interest rates fall, bond prices could rise. Okay. Oh, and if I forgot to hit the disclosures while the recording was happening here, the recording. Okay, just making sure I satisfy all compliance.
You're legal.
Yeah, I know. Yeah, we really have good people. We really do have some good compliance people. Okay, which is a rare. It's rare that anybody in our industry says that, but we really do. So yeah, so the point being here is that a traditional conservative portfolio in it would have really has taken it on the chin in the past 18 months, primarily because the conservative portion of that portfolio has not weathered the storm because of interest rates being going up. Yeah. And what I want to do, and to a little bit of that point, let me, here we go. Cue the Jeopardy music. Okay. All right. Here we go. This is the Fed funds rate, which is interest rates. Right here, you can see the rising interest rates here. And then, John, I think you have a little bit different vision on how the future of interest rates could be.
Well, that's probably the most important thing is the expectation of when and if the Federal Reserve needs to cut interest rates. Cutting interest rates is very favorable for long duration assets like equities and maybe high yield. But actually, if you're cutting interest rates because you're going into a recession, it's not necessarily a good thing for equities and high yield. So the question is, why is the Fed, cutting rates? Like I sort of say right now, is the economy is very strong, jobs are very strong. Why would the Fed need to cut rates like everyone's expecting? I would say they usually only cut rates if there's a problem in the markets or a problem in the economy. Right now, I mean, heck, retail sales came out today as surprise to the upside. So the signs pointing to the economy being stronger for longer is actually a good thing. Yes, it makes interest rates higher for longer, but that's because the economy is stronger for longer. So that's sort of, I mean, people that want their interest rates down might mean you might have to go into a slowdown, a profit recession, or an out and out economic recession. I don't know if you would want that if you were owning equities. The good news about that is on the flip side, the fixed income side we just talked about being dramatically underperforming or not being the ballast that you expect on a 60-40, let's say, balanced account. Fixed income should be fine in that environment. You'll get your 2, 3, 4, 5% coupon, and you'll get some type of total return. So you might get a high single digit, maybe even a low double digit fixed income return which is a lot safer. Let's just put it that way than your equity position. So that's sort of the exciting news here is fixed income is looking to be a pretty good opportunity, and you get to make 5% while you wait to see if we go into this recession or not.
Yeah, I mean you're not, cash is no longer trash. Right?
That's true.
Yeah. And that's really good. So it looks like, again, like a lot of our clients are retirees or on the cusp of retirement. And a typical retirement portfolio may have 30 to 40% in bonds or fixed income instruments. And that has really hasn't been a good ballast in the past 18 months, like it's been historically speaking.
Right.
But going forward, getting paid decent amount of return on the interest portion of that, and potentially maybe some flattening out of the interest rates or dropping, could prove a little juice on top of that return.
Right.
So,
We're very close to the end of the interest rate hike cycle. Whether there's another 25 coming in November, I mean, quite honestly, that doesn't make a difference if you're going from 0 to 5 or 0 to 5.25. The important move was 0 to 5%. But
yeah, that's right.
I mean, so that's the exciting news for bonds is the interest rate cycle move is over, and so that looks very interesting. The equity side, quite honestly, there's three scenarios, and that greatly depends on what happens with equities. It's, do you go into a hard landing, which is a full out recession? I mean, in that environment, bonds do great, equities don't do too well. You go into a soft landing where it's not a recession, but it's not growth. That environment, bonds again do well, but equities sort of probably are flat. And then you have one where there's an expansion mode where we actually have had the worst, and bonds are okay, but then equities do very well. So that's sort of the three scenarios that when we're looking at stocks, when we're looking at bonds, we're looking at mutual funds and ETFs, we're starting to evaluate, for that. The good thing is, Jeremy, everyone in your portfolios has a diversified portfolio. That's probably the most important thing we tell advisors and clients is to make sure you're diversified across asset classes and inside the bond portfolio, inside the stock portfolio.
Yeah. So a lot of times what we get, and this as well as I do, John, is the question, well, what's going to happen? Well, we kind of feel that this is going to happen, but do we feel that so strongly as we're going to go 100% in that direction? No, we're not.
Right.
Because if we're wrong, we don't want to get crushed.
Well, it goes back to, I like the client to sleep at night. I like you to sleep at night, and I like to sleep at night. So I would say with this pullback we've had in the market, since August, we have tactically got a little more positive. We were very defensive before that. So we did take some of our cash levels down. We did sell some defensive stocks like maybe a Verizon or something like that, a Disney. And we did buy maybe a Google, which is actually the cheapest of the Magnificent Seven. And maybe we added Netflix and we added Boeing, names like that. So that's sort of where we're turning. I sort of like say we're turning the battleship from a defensive stance to a neutral stance, because there still is that chance that we have a profit recession or an earnings recession.
Yeah. So in other words, like, and God, I kind of love that. Anyway, I'm a little bit of a geek. So my point I'm trying to make here is this: is like clients seeing things on their statement down in October or down in September or both, and as a manager, like that's what you are, right?
Mm-hmm.
You're looking at that as like, oh, that's good, because you're going out and you're buying more things. You're buying things
opportunity.
When the prices are lower.
It's
right.
It's opportunity. I would say so. That's yeah. I mean, it's being in the right place at the right time. An example of, oh, that's good is Boeing's a great stock that we love. Everyone should know the company. It's the airlines and defense stock. But what hammered Boeing over the last couple of years is the COVID crisis, where airlines basically shut down, and then they had problems with their 737 getting recertified. Their cash flow over the last 2 years has probably been like a negative $2 billion in cash flow. But when we do forecasts, we see that cash flow growing from a negative $2 billion to a positive $6 billion. And Do I know what the exact movement of the stock price is going to be? No. Do I know a stock that's going from negative 2 billion in cash to positive 6 billion in cash is going to be, equal or better than the market? Yes, we believe that. And I got an example a couple months ago. One of their suppliers drilled some holes in the wrong place and they had to recall. And so you're going to see it's going to hurt their earnings. And Boeing fell like 4% that day. We added to positions that day because we felt that it was an opportunity to invest in the long run. We look at sort of things in 10-year cycles. You have 1 year where the market sort of is definitely down. We experienced that last year. You have another year with a market, a year and a half where the market sort of is the yin and yang back and forth. That's sort of what you're seeing here. You see a strong first half of the year, a weak second half of the year. But then normally you have a 6 or 7 year period where the economy is expanding and there's no black swan events out there, and you get some high single digit returns. And that's sort of what we're preparing for. We might be we think we're a little early, so we're taking, I would say, baby steps, but it's always in the view of risk adjusted returns.
Yeah. So John, tell me, how in the world do you know this stuff about, how does you go about learning about Boeing and knowing this, what you just said, right?
Well,
I mean, just
the first thing you do, you do cash flow analysis, income statements, and balance sheets, and you do that on the financials. You talk to the airline companies, and you see what their ordering process is going to be, and you check the interest rates, and you have to go look at the competition. You look at Airbus out in Europe. What are they doing? You have to be aware of China, because China's one of the growth engines. That's a little sticking point right now, because China's been a surprise to the negative over the last year and a half, because everyone thought China coming out of COVID would be what happened in the US and what happened in Europe. And China's basically fallen. China's had difficulties. Let me just say it that way. They have not recovered like the rest of the world. And so that's been a negative. But so that's what you have to do. And then you sort of have to make a projections of what you think is going to happen with the number of airlines. I mean, the pilot situation. So there's lots of variables that go into that. That's what makes it sort of, interesting. You can do this checkpoints. You can sit there and say, okay, American Airlines is short airplanes. They need to order. And then you see an order come to American and it's 50% Boeing, or maybe it's 60% Boeing and 30%, the European one. It just depends, but that's sort of the way you have to work at it. But then after you have the fundamentals down, you have to do a valuation concern and say, is that priced in the stock or not? Is that priced in the bond? And sometimes it's already priced in, and sometimes it's not. So it just, a fun fact is, people probably familiar is a neat little stock is Netflix. Netflix ran into trouble last year when it was one of the worst performing stocks on the S&P last year. We actually added to it. Why? They have 100 million people that I would call deadbeats. And yes, 3 of my sons are those deadbeats that I'm paying, and they're watching Netflix for free. Netflix decided to change their model and said, no, we're not going to do that. And so now, actually, I just got the notice that, they either have to pay or watch the ad supported version. The interesting thing is, when you do the numbers, that 100 million people, let's say 25% of the people sign up for Netflix. That's almost a doubling of Netflix earnings. So it's interesting. I just told you a company is going to double their earnings. It has nothing to do with the economy. So if the economy slows, they'll still probably have a strong earnings profile because people are signing up. The risk to that would be that people would stop watching television. And I don't believe that.
Yeah. Hey, by the way, speaking of Netflix, there's a really good I want to say biography or whatever on one of these channels, and it was called Tech Titans or Titans of Tech. And one of them was Netflix, and it talked about how Netflix started with Reed Hastings and the mail order stuff, and how where it became but he always had a vision that that's going to be in streaming. They're going to be streaming's the future. It's hard to believe that that's what he was thinking when everything was dial up analog back in the late 90s. But thinking that way, and then he became, then it did become streaming, and then it was Blockbuster being in competition. Anyway,
going
what
to
I'm
the
saying.
grocery store. I remember going to the grocery store and getting the Netflix CD or whatever, or a disc. And, the young people don't understand that now. So I
But
remember.
what, you said the Netflix disc or the Blockbuster disc?
No, I got the Netflix one. They had the little red thing, the red box
Oh,
thing.
okay. Okay. Yeah. Yeah. That's back in, yeah, that they
I used
actually
to work
sent.
at Blockbuster too, so I remember those days.
Well, you dated yourself there, buddy.
Well, no, that dates myself.
Yeah. Me, I may, it may be black, but I'm losing a little bit back here. Okay. There's a very, and they also had a Titans attack for Google and not Google, no, Apple and Facebook. So really, real interesting. Again, that's how I geek out at night. I watch stuff like that, Um, yeah. Okay. Yeah. So what you're doing is you're looking at balance sheets, you're looking at income statements, and seeing, hey, if earnings are going to do well, typically it may have a positive effect in the company if
On
it's not
average,
priced
when
in.
earnings grow, stocks grow. I mean, that's
Yeah.
the interesting thing going into next year. I mean, I would say short term, we tend not to look at the short term, but short term, we're sort of positive here. Earnings look like they're doing strong. Seasonals have turned positive, but the main question next year is, not is the Fed done or not, but is the hike in interest rates going to cause a slowdown or not? Right now, markets are forecasting a basically 12% increase in earnings next year. I can tell you, if the S&P delivers 12% in earnings next year, the markets will be up, and they'll be up probably higher than 12%. I have a little question about that because historically, when the Fed's raised by 500 basis points, I think I saw a survey since predating the World War II, that every time the Fed is raised by over, I think it was 300 basis points, 80% of the time they went into recession, and 20% of the time they didn't. So then the question is, well, what happened in that 20% of the time? When that 20% of the time, the Fed actually started cutting rates before the economy slowed. And so that's sort of the question that we have to go right now. If we start slowing, the Fed needs to be very aggressive and cut rates. Right now, what you hear coming out of the Fed is higher for longer. We think we have one more hike. We don't, and I actually sort of agree with it. I think there is some risk that with oil prices in the Middle East right now and other commodities that you could have, some lingering inflation effects. We might not get down to that 2% number that the Fed likes, and we might stop at 3 or 4 and then bounce up for that. That we probably would not want that in the long run.
Yeah. Okay. Understood. Yeah. So in other words, you got an idea, but you don't bet the farm on it.
Right. I mean, for example, people ask, well, is the market expensive? I would say the Magnificent Seven stocks that people, led by NVIDIA, led by Facebook/Meta, that group of stocks is very expensive. Now, granted, they have strong balance sheets and strong earnings, but you're paying a pretty penny for those stocks. The other 497 stocks, 93, got to do my math, 500 minus 7. The other 493 stocks are actually relatively priced, and there's some interesting areas in there, whether it's in energy, whether it's in utility stocks. Utilities, because of rising rates, have gotten slammed in the last 3 or 4 months. You're getting decent yields with companies that are stable, that aren't going bankrupt, that have appeal in the long run. And so there's always aspects of the market you can look at, even though we're saying maybe the market's a little high, there's always value to be found somewhere in the markets.
Right. So like if you see, the market being down, I don't know, 15% or so, or up 15% or so, there may be a lot of different areas that could represent a lot of value. Did you say something about the Russell 2000, which is the smaller companies, about the percentage of the companies that are down or not making money?
The interesting thing is the small cap land, which is the Russell 2000 is a small cap index, and small cap is massively underperformed the last 2.5, 3 years, and so much so that by valuation terms, they look very valuable, very bet the farm-ish type event. But then when you look at the Russell 2000, the last statistic I saw is 40% of the Russell 2000, the companies do not make any money. That's, to 40%. Me, That's a staggering number, because and what does that mean? That was fine the last 10 years, because think about it. If they had to get cash, they could go to their bank, they could take cash out of their ATM and pay 0% interest rate on it. So they were fine. Now they have a little trickiness where they actually have to pay money on that. It's
What?
almost like they have to be normal.
Pay the money back? You got to be kidding me, really? Yeah.
But what we do think is interesting is those small cap stocks that have good businesses, have good balance sheets. Let's say the other 60% of the Russell 2000. That's a very appealing area right now. Another area that looks very interesting is internationally. International stocks have not been this cheap in over 20 years.
Wow.
There are some issues out there. Like I said, China's slowing down, so that's an issue. You have the Ukraine war, so that's an issue. And you have just recently the unfortunate, aspects that's happened in the Middle East.
Yeah.
But sometimes it goes back to that opportunity that we talked about. Are the stocks so much depressed because of these outside uncertainties that there's value there? But we're starting to say there is some value there, but once again, it's not like we're not going to jump both feet and say cannonball and go buy 20-30% international stocks. We might add one or two here or there in our portfolios or your clients' portfolios.
Yeah. All right. Yep. I mean, it makes sense. By the way, if you got questions, feel free to type that in the chat feature. And I think you have the ability to send it, not public. You can send it, directly to me, and so you can do that. So don't worry about it. The other attendees won't judge you on your question. Believe me, the rest of them probably have the same question. So remember to type the question in the chat feature there, and happy to try to help answer that for you. So we were talking about this before the call that, I just got back from Vegas, right? I turned 50 this year, John, actually last month. And me and my wife decided to go to Vegas last week. We saw Adele and U2. By the way, it was phenomenal, right? I digress. But my point is that when we were flying, the pilot said halfway through our flight that we were probably going to experience some rough air. But guess what? We didn't experience any rough air, but he was prepared. And so that's kind of what you guys do, is like, hey, we prepare. It doesn't mean we're always right, but the idea is to get there safely and land safely, right? And then from our point of view, talking about to the client, is that we look at the whole financial picture, assets, liabilities, income, needs, and prepare as best we can for things upcoming in your life and for things upcoming in the economy, right? And then so that, guess what, that you can live your life, and so with hopefully less worry, less burden, right, and all of that. So that's why, like, if it's really important that if something changes in their lives, they need to let us know, and so that we can prepare accordingly.
Well, that's like for the markets, just playing the markets can be hard on the planning side of it, the retirement planning, because you can be up 20% one year, you could be down 20% one year. And so it's much better if the advisor can sit there and say, oh, let's count on an 8 to 9% return through time. And instead of saying, oh, we need 20% returns, that's very difficult, because if you need 20, the odds are at some point you're going to be down 20, and then that's not good. So that's why we're trying to deliver to you and your clients a risk-adjusted return that has upside participation and downside protection. Because if we want to be wrong, I'd rather be wrong in the up market. I'd rather go to you and your client and say, hey, I'm sorry, the markets were up 20%. We're up 18%. I apologize for that. Rather than me coming to you and say, hey, I'm sorry, the market's down 20%. We're down 30. Oh, and by the way, that means you might have to go back to work because of that. But I'm sorry about that. That's something that I just don't, I never want to confront.
And then, what? That's why we like you guys.
So
that's why we like you guys, because when you're trying to generate income for people, underperforming on the up is way better than underperforming on the downside. Yeah.
Right. And the good news is about generating income is Mr. Market has finally let let a CD or treasuries, bonds give you nice income. So that because the last, quite honestly, 15 years has been a struggle for people on retirement or something like that. So, but I
Yeah.
think that's good news. Is there is actually alternatives to equities now.
Yep. Again, you're getting paid to wait in an instance like that. So one other thing that I'd like for the people to know is I'm gonna share my screen again, is total returns. The bars here represent the S&P 500, okay, both up and down, and you can see the year, like let's just say I don't know what year it is. Let's just say 32 was up 32% this year, and with that, or this calendar year, it was down 3% here. But if you see the red dots on the bottom here, this is where it was at the bottom of those years. Okay. So for instance, even though it ended the year up 13%, at one point in time in that year, it was down 7.
Right.
Even though it was up 32% in this calendar year, at one point in time in that year, it was down 7. And in this one, it was down 19 and ended up down 3. My point is that like thinking about me flying to Vegas, there may have been times of rough air. Fortunately, there wasn't for my wife. She's a real skittish flyer. But if there was some skittishness, right, we still landed safely. Okay. Now, everyone here has a 100% survival rate to this point in time. Okay. You're still here. And so you have experienced some tough times in the past. If things get tough, John's going to adjust. Okay. Does it mean it's going to be perfect? No, but what it means is we're managing risk on the investment planning side, on the investment management side. As you can see, my hand, I'm pointing at John here. On our side, in thinking about your cash levels and thinking about your distributions from which accounts, and we're thinking about Social Security optimization and things like that, we do those things to help manage as well. Okay. Okay, perfect. I love a question. What's the difference between CDs and bonds and the time limits? Great question. All right, John, you want to get that one, or you want to?
Well, CDs are issued from a bank. So, and the times from a CD, you can have a 30-day, a 60-day. It goes up to 5 years. I've actually seen even a 7-year CD at one point. Actually, my single best investment in my entire lifetime was when I was 18, and I bought a 7-year CD that had an 18.5% yield. Because that was back in actually 19, dating myself, 1980, 81. But that's that's a locked in rate. Normally, it's a locked in rate that's paid interest. Sometimes it's paid outright, monthly, or sometimes it's paid at the end of the term of the CD. It's insured by the federal government if it's under $250,000. Although recently they made everyone whole, so that's sort of a CD. A bond is a fixed income security, either coming from a government like the United States or coming from a corporation, let's say Disney or JP Morgan, that basically says, we will pay you a certain amount of interest, on your investment, and it's a fixed amount. That's why it's called fixed income. So they vary. Usually bonds are publicly traded, so they're out in the market, so you can see a price goes up or down, where CDs usually don't have a public market, so they're sort of fixed.
Okay, so I'm going to piggyback on that just a little bit. A lot of times the CD income you get from the CD, you don't realize that until the end. A lot of times you put the money in, you don't really see any volatility on your statement at all, although theoretically it's still there. And then you end up getting your interest and your principal back at maturity, generally. On a fixed income, let's say like you're talking about JP Morgan or US Treasury, you put your money in, you get paid income while you're holding it, and then you get a matured value, generally your principal amount back at maturity. Okay. And bonds can last anywhere between a month, 2 months to 30 years. Right. And so that's the difference between a bond and a CD. But one other thing about a bond, the prices of those bonds go up and down. Remember how we were showing in the beginning of this thing, where if interest rates go up, bond prices go down. All right. Now you just generally you're gonna still get that income from that bond, even though the bond price is down. And if you hold it to maturity, you hold that bond to maturity, you should get your principal back. Okay. I say should. That unless the company goes bankrupt, even if they do go bankrupt, you may get your money back. Okay. I say bankrupt like US government or whoever's issuing the bond. Did that answer you? If that answered your question, great.
One thing I did want to point out, one little nuance is there's a thing called municipal bonds, which are from state or local communities, and those are tax-free. So that is something that's sort of different than a CD and your standard bond is you get paid a rate, and sometimes it's state, local, and even federal tax-free, depending upon what state you're on. And that's something clients that you work with your clients on, depending upon their state and their locale. But that's another,
now guess what?
Aspect you should look at.
Absolutely. Good point, John. Is that the interest rate you generally get on a municipal bond is lower because it's state and federally tax-free. All right. And so generally now, typically if someone is making in the 22% tax bracket or lower, it might make sense to do taxable bonds versus tax-frees. And 20 to 32% tax rate can go either way. And anybody over 32% might make more sense to do the municipal bonds. So in a taxable account, tax-free accounts or IRAs, it doesn't matter. Although guess what, John, I have seen people have municipal bonds and IRA accounts for whatever reason.
Sometimes municipal bonds are actually good investments just by themselves.
That's right. Well, because they're a municipality, typically the default rate's very low. Right. Again, so any other questions back out there? Thank you very, very much for the question there. Any other questions, thoughts, comments? Okay. If you do, certainly feel free to email us, jeremy@riverbendwm.com. I do want to do one final thing here. I'm going to share disclosures again, Mr. Compliant person. All right. Here, read. If you got questions or comments, certainly feel free to email us. Oh, wait, someone raised their hand. Okay. Oh, no, she sent the question. Okay. All right, good. If you got questions or comments, certainly feel free to email or call us. If you got topics that you would like to hear on the next Riverbend call, Call for Riverbend call, certainly feel free to email us out. We're getting toward the end of the year, and some key things that I'd like for you guys to think about. All right. And we do that on our side for your accounts, is taking tax losses or tax gains, depending on your particular situation in taxable accounts. Donate money. If you're over 70.5, use the money from your IRA accounts, or donate to a donor advised fund. Also, you can fully contribute to your health savings account prior to filing for taxes. Contribute to your 401k accounts if you qualify. Take your RM, required minimum distributions. If you're with us, we'll take care of that. And again, just keep us informed anything that changes in your life. All right, because we got your stuff set up because of what you told us. Okay. If things are outside of us, it's hard for us to manage. But what we try to do is get statements from there and do the best we can with the information we got. Does that make sense? Okay. Any other final questions? John, any other parting shots here, buddy?
I just think, remember, the markets don't like uncertainty. So whether it's uncertainty in the Middle East, whether it's uncertainty with our politics, but some of those stuff will get solved we might not like the way it gets solved. It's like when they make sausage, you know, you don't want to see how the sausage is made, but I actually think things can turn out. So we're actually thinking the markets have a pretty good, nice run here at the end of the year. Next year, the question is, do we go into recession and do earnings earn that 12%? And those two answers will tell you which way the markets are going to go.
Okay, perfect. I got another question. So why do they have required minimum income distributions? All right. So IRA accounts. In a traditional IRA account, when you put money in, you get a tax deduction. You save some money on taxes. That money grows without paying any taxes on it. At a certain age, which now it's it's in your 70s, they require you take out a portion of that money. Why? I'm going to ask a question. Why do you think the government would want you to take money out of an IRA account? And I know you answered the question, taxes. They want you to pay taxes on the money. That's why they want you to take the money out. Okay. Now, fortunately, required minimum distributions depend on your age. And typically they start at 73. Between when someone retires and age 73, you can do tax planning, you can do Roth conversions and a few things like that to help lower your potential required minimum distributions at 73 or later. And that can be very advantageous tax-wise. It's called basically it's called tax arbitrage. It's better to pay 10 to 12% tax instead of 22, 25, 32%. Okay. But when we look at your overall picture, we're thinking that not just now, but what's going to happen 5, 10, 20 years down the road for you. And so that's what we try to do. And if we didn't bring it up to you, it's very likely we already considered it and it didn't make a lot of sense to do it. Okay. But the reason the government wants you to take the money out, taxes. They want you to pay taxes. That's why they don't want you to, they don't mind. You don't have to take money out of a Roth IRA because the government's not going to get any money back from it. Okay. All right. John, as always, it's a wonderful pleasure. Thank you very much for your
This
wisdom
is fun.
and
I like this one. No problem.
Yeah. Yeah. And certainly feel free to give us a call at Riverbend 843-970-1049 or email me at jeremy@riverbendwm.com.